Hey everyone, thank you jumping back to the Crypto Odds. Please subscribe the channel and thumbs up the video. Today, let's take a look at why the market has taken a hit and where the main problem. If you look at the Federal Reserve Balance Index, the expectation was that in the October, when the Treasury reached its the target of 850 billion, the Fed would inject money into the market. However, due to the government shutdown, this money did not enter the market by October. Even more money had been pulled from the market and reaching to 1 trillion, effectively drying up liquidity in the market. On the other hand, the overnight index, a private rate between banks and the Federal Reserves, last occurred during the pandemic when banks borrowed from the Fed but pledging their securities as a collateral and at a fixed interest rate in order to control rising interest rate caused by the drying up of liquidity in the banks. When this happens, money is scarce in the market and liquidity is being drained. Banks generally prefer to lend to each other, but this time, due to the poor economic situation, there is a lack of trust between them, and they are afraid of lending to each other because of the risk of the bankruptcy. The Fed is providing money for these banks not to circulate among the ordinary people, but primarily to provide for the bank. If you look at the ETF outflows, the volume isn't huge, but you see, $186 million, $149 million outflow. But because liquidity in the market is low and there aren't many retail investors, even the smallest sell-offs can trigger significant market drops. And companies like Amazon, Meta, and UPS have laid off thousands of their employees, as I showed you before in my 2 days ago video. The labor market is moving toward a slowdown in hiring, with the job opportunities reaching their lowest levels in the past 4 years. The stock of these companies are still rising because of AI. Companies have reduced costs and increased profits. This level of layoffs is pushing us toward a major recession, and Jerome Powell, by following the wrong policies, is adding fuel to this fire. The market has weakened to the point where companies are resorting to massive layoffs. We are approaching a situation similar to the pandemic era, and even though who are employed feel less job security, They discourage job mobility and new labor entrants face tougher and competition for job opportunities with the wage and benefits either stagnant or declining. This situation slows economy growth and could lead us into the recession, putting the Federal Reserve under the pressure to control inflation. The labor market is now it's not at it's not at a good situation because because last month we got a huge amount of the people they lost their jobs, and we don't and our job opportunities decrease sharply. You might ask why altcoins aren't rising. It's because retail investors don't have money to buy them. If you look at this chart, the personal saving rate, the amount of the money or ordinary people are able to save, we have reached the levels lower than during the COVID. You see, we got the bottom. Actually, we got the bottom at 2022, but right now we are at the lowest level of that. And people simply don't have money to save with high inflation, high expenses, and stagnant or declining incomes. People are getting poorer every day. Many are losing their jobs, leaving them with nothing, leaving them with nothing left to invest. If you look at this chart, the tech jobs in California are declining at an alarming rate, approaching level not seen since 2008. We are at the lowest level we haven't seen till 2008. You see? And on top of that, the Lisa Cook, an unpopular Democrat, supports cutting interest rates. It seems to indicate that the Democrats are coming to their senses. A significant part of the Federal Reserve is more concerned about the economic recession than inflation. When Cook says that a weak labor market is more important than the risk of inflation, it means the market needs more liquidity further in the future interest rate cuts, ending QT, and quickly starting quantitative easing could help stabilize the situation to some extent. Okay, let's go jumping to the chart. If you are looking the Bitcoin at the 4-hour time frame, a clear head and shoulder pattern can be seen in this chart, and the target for this pattern is around like 102 to 98,000. Yes, we can see clearly the target of that head and shoulder. See, like that, 98,000, 96,000, like this one. And beside that, we must not close weekly candle below our 50 weeks moving average, which is 102, most important level for us. And if that happens, the downside scenario could intensify, potentially pushing Bitcoin down to, if you are lost this level 102,000, we could go downer to 90,000. And this level, it's not the major support level for us. If we are lost this 50 weeks moving average at the 102,000, we can go downer to 74,000.